Welcome to the Dev Journal. We are tracing the massive rush toward infrastructure expansion as specialized intelligence models and satellite networks become the new standard. However, this aggressive growth is running head first into the reality of fragile supply chains and market valuations that feel increasingly disconnected from the physical truth. We will explore how the European Union is spending 180 million euros to secure their digital autonomy, while Open Artificial Intelligence releases a new defensive tool for security professionals. These moves suggest a growing urgency to protect systems that are becoming far too complex for human teams to manage alone.
Sloan, those defensive measures are expensive, but investors seem unbothered by the price tag. I am analyzing the $11.7 billion satellite acquisition by Amazon as they head into an earnings report with technical indicators flashing red. We need to determine if this bullish sentiment can survive the actual numbers.
Vance, the market might be looking at the sky, but we have to stay grounded in the code. From software supply chains to orbital data networks, the landscape of power is shifting. We begin with the launch of the latest specialized security model and its impact on cyber defense. Open Artificial Intelligence is fundamentally changing how we define safety by moving away from those blunt, frustrating filters that often block research. By implementing a strict Know Your Customer framework for their specialized cyber model, they can finally grant thousands of verified defenders the freedom to analyze malicious software without the model constantly refusing their requests. This shift toward identity-based controls is a massive milestone for the Trusted Access for Cyber program. It allows the model to differentiate between a malicious actor and a security professional. Instead of a one-size-fits-all restriction, we are seeing a nuanced system where trust is earned through verified credentials and rigorous background checks. This sophistication extends deep into the infrastructure layer, where the company manages their high-capability models. Their preparedness framework now uses automated monitors to scan traffic in real time. If the system detects something high risk, it automatically reroutes that traffic away from the powerful Codex model to a much less capable 5.2 version. It is a clever way to maintain security at scale while empowering the good guys with tools like binary reverse engineering. Defenders can now deconstruct third-party libraries without ever seeing the original source code. This capability levels the playing field for teams that previously had to rely on manual, time-consuming defense analysis.
Sloan, you are highlighting the efficiency, but you have to look at the trade-offs because that automated rerouting adds a layer of latency that could be a deal breaker during a live incident. While shunting traffic between model versions sounds elegant, the computational overhead of constant monitors introduces a complexity that many operations centers will struggle to integrate. There is also a significant privacy cost to this visibility that we cannot ignore. Open Artificial Intelligence explicitly prohibits zero data retention environments for this model to ensure they can monitor user intent. This effectively creates a massive centralized honeypot filled with the most sensitive vulnerability research data from hundreds of different corporate security teams. Unlocking binary reverse engineering is a permanent capability gain that makes me nervous. Even with identity verification, those controls are only as strong as the authentication layer. If a verified account is compromised, a malicious actor suddenly has a powerful engine for finding deep flaws in compiled code without needing the original source. We are essentially betting everything on the integrity of the verification process and the security of the model provider. This tension highlights a broader problem in our industry where we rely on centralized trust. It is time we shift from the promise of intelligence-driven defense to the practical failure of trust in modern build pipelines.
The security breach at Vercel in April 2026 exposes a growing crisis I call epistemic negligence, where we are seeing developers outsource their entire threat models alongside infrastructure abstractions without realizing that delegating technical operations does not magically erase the underlying security risks inherent in their complex production systems. This incident was far more than a minor glitch. because it actually exposed critical production secrets, including private application, programming interface keys, and the database uniform resource locator, to unverified third-party dependencies during the very build process that was originally meant to streamline and simplify their software deployments. Engineers must now return to first principles by explicitly documenting every risk they delegate to their service providers, rather than assuming a platform is inherently secure just because it is convenient. Because success in this new landscape requires a transparent audit of precisely where that trust might fail. Vance, when we look at the mechanical side of this failure, how do we move beyond just recognizing the danger and actually start hardening these automated build pipelines against such invisible supply chain threats that seem to bypass our current security measures through a more rigorous verification process?
While features like incremental static regeneration and edge functions simplify our lives, they also obfuscate the build delivery chain where this compromise occurred, acting as a double-edged sword that masks the complexity of the underlying system and prevents us from seeing when a malicious dependency is present. We have to acknowledge that standard node package manager audits are frequently failing us by missing malicious scripts buried deep within a complex dependency tree, which is why I advocate for using low-level tools like JQ for post-install auditing to allow for a granular inspection. Beyond auditing, we should be implementing sub-resource integrity tools to enable browsers to verify script hashes while using a dedicated secrets manager like Railway to help solo developers isolate runtime secrets from the build pipeline, ensuring that a build failure does not become a total data catastrophe. Shifting from individual developer negligence to a much larger scale, the European Union is now awarding a €180 million sovereign cloud contract to bolster its digital autonomy and reclaim its critical infrastructure from the dominance of foreign providers as geopolitical concerns over data control intensify.
This strategic investment of €180 million serves as a vital shield for 40 separate European Commission agencies, protecting sensitive data from the far-reaching implications of the United States Cloud Act. By establishing this sovereign infrastructure, Europe is finally drawing a line in the sand regarding where its most critical digital assets actually reside. Currently, 3 major United States-based providers control approximately 70% of the regional cloud market in Europe, creating a dependency that many leaders view as a significant geopolitical risk. This initiative is designed to break that cycle of reliance, fostering a local ecosystem where European providers like Post Telecom can finally compete on a more level playing field. The inclusion of the S3NS joint venture between Proximus and Google Cloud shows a sophisticated and pragmatic approach to this transition by leveraging established technology while maintaining strict operational control. This hybrid model ensures that European agencies do not lose out on cutting-edge capabilities, while they work toward full technical independence from foreign jurisdictions. But looking at the sheer scale of the global cloud giants, I wonder if a 6-year contract is enough to truly shift the gravity of where data lives. Vance, how do you see the engineering trade-offs playing out when we prioritize these political and sovereignty requirements over the massive research and development budgets of the hyperscalers?
To be blunt, €180 million is essentially a rounding error compared to the billions that Amazon Web Services or Microsoft Azure spend on infrastructure and security every single year. While the political goals are clear, we often see that sovereign cloud solutions end up trading away raw performance and feature velocity just to check a compliance box. Using a joint venture with Google Cloud to achieve sovereignty from the United States tech stack feels like fundamental contradiction that might not hold up under scrutiny. If the goal is true digital autonomy, relying on the core code and architecture of a Silicon Valley giant seems like it is just shifting the problem rather than actually solving it. The upcoming Cloud and Artificial Intelligence Development Act will mandate technological openness and interoperability to prevent vendor lock-in. But that is much easier to write into a law than to implement in code. Developers might find themselves struggling with fragmented systems that lack the seamless integration they have come to expect from the dominant global platforms we use. We are watching a massive tug of war between regulatory ideals and the reality of technical dominance that continues to shape every major investment decision. Hard pivot to the financial markets, where massive infrastructure investments are meeting extreme technical exhaustion, as we look at the 21-day outlook for Amazon ahead of their latest earnings report. Looking at the technical indicators for Amazon right now, we are seeing a level of exhaustion that should make any disciplined trader pause. The 14-day relative strength index has hit 93.40, an almost unprecedented figure for a mega-cap company that suggests the stock is currently priced for absolute perfection. This technical peak coincides with an $11.7 billion acquisition of Globalstar as they push into direct-to-device satellite services. While expansion is the goal, the capital expenditure has reached a staggering $131.82 billion, reflecting a massive investment in fulfillment and infrastructure. The engineering reality is that Amazon Web Services is currently grappling with significant supply constraints that likely will not ease until new capacity arrives in 2026. For a company valued at this level, spending heavily on future satellite networks while current cloud growth is capped creates a very risky timeline. The market is essentially ignoring these bottlenecked resources in favor of a narrative about global connectivity and future dominance. Sloan, how does a business justify this level of spending when the operational costs are already keeping their net margin suppressed to just 10.83% despite the massive revenue?
The logic behind that $11.7 billion satellite bet is about capturing the next frontier of the total addressable market. By integrating satellite connectivity directly into the consumer and Amazon Web Services ecosystems, they are removing the final geographical barriers that limit where their digital and physical services can actually reach. While the technical signals suggest the stock is overextended, the fundamental floor remains incredibly solid, with 31.09% year-over-year earnings growth. This is not just speculative hype. It is a company generating $77.67 billion in net income while maintaining a 50% gross margin. That massive capital investment you mentioned is exactly what allows them to maintain such a dominant position in the retail and cloud sectors. Even with the heavy operational costs of a global fulfillment network, analysts are still pointing toward a bullish price target of $315, which represents a massive upside. We are witnessing an era where the sheer scale of these tech giants allows them to redefine entire industries through infrastructure alone. This trajectory of massive valuation and global reach leads us naturally to Apple, which is currently navigating a historic $4 trillion valuation alongside a major leadership transition for the coming years. Apple has officially crossed that historic $4.01 trillion market capitalization threshold, a figure that is supported by $98.77 billion in free cash flow. This level of financial strength provides an incredibly stable foundation for the company as it navigates the upcoming transition to its next leadership chapter. Investors are feeling particularly optimistic because of the 20% surge in iPhone shipments within China during the first quarter. This rebound in a critical market reinforces the bullish sentiment and helps justify the consensus price target of $297.46, even as we approach a high-stakes earnings announcement. The decision to name John Ternus as the successor to the Chief Executive Officer for September of 2026 is a masterclass in corporate stability. By providing a clear 2-year runway for this transition, the board is ensuring that the market remains confident in the company's long-term vision and valuations. Do the raw efficiency metrics behind these massive numbers actually support this kind of valuation growth through the middle of the decade? I wonder if there are specific pressure points in the balance sheet that might make this $4 trillion valuation harder to defend than the headlines suggest for you, Vance.
Technical indicators give me plenty of reason to pause because the 14-day relative strength index is sitting at 78.40. That puts the stock deep into overbought territory. And while the earnings report is being called a clearing event, there is significant risk if the market expects a major price breakout soon. There is also the matter of their liquidity management, specifically a current ratio of 0.89, which is remarkably low for a corporation of this magnitude. While they generate massive cash flow, running such a lean balance sheet means they have very little margin for error if there is any disruption in consumer demand. Maintaining a gross margin of 46.91% is an engineering feat in itself, but I question how much higher the next leadership team can actually push that figure. As the company matures, finding incremental gains becomes exponentially more difficult, especially with a net margin that is already stretched quite thin. We will see if that April 30th earnings call provides the 5% price movement that Morgan Stanley is currently anticipating. It is certainly a different conversation when you contrast the stability and massive cash flow of Apple with the extreme valuation to margin disconnect we are currently seeing over at Tesla.
The financial narrative at Tesla has shifted toward a concerning divergence between operational scale and actual profitability today. We are seeing a significant 14.03 percentage point gap between their 18.03% gross margin and a razor-thin net margin of only 4%. This compression is manifesting in a year-over-year earnings collapse of 46.79%, which suggests that the previous lean manufacturing advantages are being swallowed by broader operational costs. It raises serious questions about how the business maintains its identity as a premium high-margin producer. Management appears to be aggressively pivoting the brand story away from traditional automotive metrics and toward an artificial intelligence powerhouse by signaling capital expenditures that will exceed $20 billion for robotics initiatives. They are essentially asking investors to ignore today's fundamental decay for a future tech promise. But does the market truly have the stomach to wait for these long-term bets, while the core automotive engine is clearly sputtering on the assembly line? I wonder if those engineering trade-offs make any sense when you look at the actual delivery numbers we just received, Vance.
It is difficult to justify a price-to-earnings ratio of 363.43 when trailing 12-month revenue growth has actually turned negative at 2.93%. The math simply does not add up for a growth stock when the top line is shrinking while valuation remains high. The first quarter delivery figure of 358,023 vehicles missed even the most conservative Wall Street forecasts by a wide margin. With a high beta of 1.92, this stock is primed for extreme volatility as the market realizes the core business is underperforming expectations. Doubling down on robotics while automotive margins erode is a high-risk gamble that could easily backfire if the technology does not scale quickly. Technical indicators like the relative strength index of 63.73 show a dangerous divergence that could test the $360 support level. The coming weeks will reveal if these massive infrastructure bets can ultimately outweigh the deteriorating fundamental performance we are seeing across the entire electric vehicle sector. This provides a final summary of how infrastructure bets are being weighed against fundamental performance across all sectors as we end the day. Consider Open Artificial Intelligence launching their Generative Pre-trained Transformer 5.4 cyber model, or Amazon, dropping $11.7 billion on satellite acquisition. This aggressive push for dominance is undeniable, but the Vercel 2026 breach remains a harsh reminder that scale does not automatically solve systemic supply chain vulnerabilities.
This tension between massive capital spending and systemic fragility is the defining challenge of our current era. While companies race to build sovereign clouds and specialized intelligence, they are doing so against a backdrop of extreme valuations and a supply chain that feels increasingly brittle under the weight of these global ambitions. As we watch these architectural shifts unfold, we have to ask if the speed of expansion is outstripping our ability to secure the foundation. Thank you for joining us today for these technical deep dives. We will be back tomorrow to track how these numbers and narratives continue to shape the technology industry.